Welcome to chapter 14. What is inflation? There are three main objectives in this chapter. The first objective is to understand what is inflation, and the second objective is to understand how and why does the government inflate the currency, and the third objective is to know how does inflation affects bonds and stocks. So let's get started. And I am sure everyone can remember when they sat down with their grandfather and he said that he could buy a gallon of gas for 36 cents or whatever the case might be. And when you hear those stories, this is what we are talking about when we talk about inflation. So why does the government inflate the money? Federal Reserve will tell you that they inflate the money because it allows them to protect the country from deep recession or depression. But another reason that a lot of people really don't talk about is that it serves as an indirect form of taxation. As we get a little bit further into this lesson, you understand how that is actually a form of taxation. But the main thing that you need to understand is that inflation occurs because the federal government increases the supply of money. So let me give you a quick example. Let's assume we have a kid here named Lauren and she loves chocolates. And because she loves chocolates, she is going to do some chores, helping to her parents. So she can get some money and go buy the chocolate. So Lauren goes and works for her parents. She waters the flowers and help them in gardening work in their backyard. So her parents give her $4 for gardening work. And what you have to understand is that the money is nothing more than a symbol of work that's been performed. So Lauren performed some work, her parents gave her some money, and then Lauren can trade that money for the work that somebody else does. Always remember that the money is nothing more than a symbol of work that's been performed. So Lauren takes that symbol of work performed, which was $4, and she goes to the supermarket and she can buy chocolate in the year 2020, which is the year that she performed that work. Okay, now let's say that Lauren performed that work. She got the $4 from parents in year 2020, but she waited an entire year until 2021 due to the COVID before she was able to go out and buy the chocolate. But now the cost of the chocolate is $5, and Lauren still performed the same amount of work. She still did the exact same thing, and in one year she could buy the chocolate, but in the other year she could not buy the chocolate. And that was because of inflation. So, what caused the price of the chocolate to go from $4 to $5? So as we look over here, let's look at year 2020, and we have four people, and we are going to say that these four people symbolically represent all the people across our entire country. Okay, and let's just say that the federal government has put $1,000 into this system of people that are working, and that $1,000 is what they have to use to trade amongst each other. Because remember that the money is just a symbol with their work. Since it's a symbol of their work, they can trade it amongst each other. As they continue to trade the $1,000, the value of each dollar is dependent on what that person might need, whether it is a food, clothing, transportation, or whatever. So let's take these four people and let's go ahead and look at the year 2021. And in this scenario, let's say that the change occurred that the federal government, instead of putting $1,000 between these four people, they put $1,200 instead between these four people. Same number of people, different supply of money, which is just the symbol of work that they are performing. So, as they are doing their work and there is more money in the system, the value that they are going to charge for services or products that they are creating is going to be higher because there is more money in the system. So, let's say in the year 2020, whenever there was $1,000 in the system, one of these people could go buy chocolate for $4. But whenever we put $1,200 in the system in the year 2021, the chocolate does not have to be $4 anymore. It could go up maybe $5 or whatever the case might be. It's higher cost because it's relative to everybody in the system that did not change in the population, but the money supply did. So that's what the Fed is controlling. And they are just gradually increasing that amount of money in the system. and that's how the money becomes inflated. So how does Fed actually control the amount of money in the system? Now, there are many different ways that they can do it. They can actually physically print more money, but the way that they commonly adjust how much money is in the system is through banks. So the Federal Reserve sets a thing called reserve ratio, and in this scenario, we are going to say that the reserve ratio is 20%. So if this man takes $1,000 and he takes it to the bank and he says, "Hey, I want to save this $1,000," the bank then puts it in his account, his digital account. He would check on this computer or whatever, and then the bank then takes that money and they have the ability to lend it to somebody else, which everyone understands. But what a lot of people don't realize is that the bank, based off that reserve ratio, that's how much money they are allowed to lend out from the money that they have received. So since the bank received $1,000 from this customer, they have to keep $200 on hand, and they have the ability to lend out another $800. Okay, so let's see what happens when the bank lends out that $800. So now they lend this $800 to this woman here, and let's say she takes that $800 and she saves it into the bank. So based off of that rule, 20% reservation rule, the second bank which this woman has gone to has to hold 20% of that $800. So the bank would hold $160, and they have the ability to lend out $540 now. Remember, we've only started with $1,000, okay, and now we are already up to another $800 in the system. And now the bank is going to lend out the 540 from that bank. And so what you see is that this guy saves 540, which means the bank has to keep $108 on hand, and they can lend $430 to the next person comes along, and the process goes on and on and on. Okay, so as you can see, based off that reserve ratio, as that process continues on, $1,000 initially saved in the system actually turns into $5,000. So you can see that the supply of money, if you were talking about actual dollars in the system, it's actually, if you take one divided by that reserve ratio, that's going to give you the actual amount that you got to multiply the base amount of money by. So let's take 1 divided by the 0.2, which is 20%. That gives you a 5, and you would multiply 5 times $1,000, and that gives you the $5,000. That's calculated. So what happens when that ratio changes? So what would happen if the reserve ratio is 10%? So if you went through that whole scenario again, and when this person by person $1,000 at a 10% reserve ratio would actually turn into $10,000. Okay, because when we take 1 divided by zero point 0.1, that gives us 10, and we would multiply by 10 by 1,000. So you can see the federal government, when they adjust that reserve ratio from 20% to 10%, they just created another $5,000 in the system if there was only a base $1,000 in there. So they can quickly adjust how much money is in the system just by adjusting the reserve ratio. So this is just one way that the Fed can adjust the amount of money in the financial system. But what we need to know as investors is how inflation or the devaluation of the money affects your investment. That's what really matters here. When the Fed adjusts these rates and they inflate the money more, how does that affect your bonds and how does that affect your stocks? And that's the question that we really got to understand and answer. So let's start with bonds. How does inflation impact your bonds? So let's take this scenario. We have David on the left, and he's going to lend $1,000 to Sarah, and Sarah is basically selling down a bond for $1,000, and the coupon on that bond is 5%. We are just going to assume that this bond is a 1 year bond so that we can kind of see how the inflation impacts it. Okay, so $1,000 to Sarah. Sarah has to give that $1,000 back after 1 year, and she is going to have to pay 5% on it. So let's assume that during that year from 2020 to 2021, 5% inflation occurs during the time frame. So 2021 comes along, and Sarah has to return David's $1,000. So she gives $1,000 back to him, and she also has to pay a $50 coupon, which was the 5% interest on that $1,000. Therefore, David has $1,050 in 2021. But due to the 5% inflation, the $1,000 in 2020 money is actually equal to $1,050 in the 2021 money. So those two numbers are equal. So even though David might think he made $50, David actually made no money because his buying power is exactly the same in 2021 as it was back in 2020. So how does inflation impacts bonds? Inflation impact bonds? Well, it drastically impact bonds. In order to see what the actual yield is, you have to take the bond yield and you have to subtract the inflation rate, and that will give you the actual bond yield. So in that last scenario, the bond yield was 5%, but the inflation rate was also 5%. So the actual bond yield was 0%. Now, a caveat to this, and I don't really get into too much here, but you can do more research on it. It's something called TIPS, and that is Treasury Inflated Protected Security. So, how does inflation impacts stocks? So, we know that with bonds, it's not good. So, let's say what happens with the stocks. Let's say David buys ownership of Sony stocks. He buys $1,000 worth of shares for Sony, which is probably he's going to get about one share. Let's just say he goes and buys $1,000 worth of Sony stock, okay, and that happened in 2020. During his ownership from 2020 to 2021, the same 5% inflation occurred. So let's look at this from Sony's standpoint. In 2020, Sony's cost of material was $100. Their sales price, which is the price that they are going to sell their product for, is $200. And these are the just numbers that I am coming up with to really make all the math really simple. So if it costs them $100 to make the product, they sell for $200, their net income is going to be $100. So as we look to year 2021, because of the 5% inflation, the cost of their materials went up by 5%, and it costs them now $105 to buy their materials. But because of that increase in the cost, they are now able to go ahead and sell their product at a higher price because there is more money in the system and people can afford that, and they translate that cost of those materials over to the customers instead of themselves, and so their sales price is now $210 as opposed to $200, which is also a 5% increase. So when we subtract the price from the materials, then that income is $105, which is a 5% increase. So what Sony did from 2020 to 2021 is they automatically adjusted because the cost for them to do business was increased by 5%. So they then translated that cost over to their customer, which was their price was raised by 5% and their net income was raised by 5%. David back in 2020 was buying ownership of Sony, and it was trading in a multiple of the earnings, which the net income was $100, and so he purchased his shares for 10 times the earnings, which would be $1,000. As we look at the year 2021 numbers, if the multiple remained exactly the same, David shares are now worth $1,050. So his shares automatically kept in step with the inflation because net income increased to $105. So how does inflation impact stocks? As a result, stocks with no debt are generally unaffected. So here is a quick caveat to that. If the inflation moves the price point of a product outside of the market's desire, inflation will absolutely impact the stock's performance. But generally speaking, stocks are not really affected all that much by inflation like the bonds are. So, this concludes the chapter 14, What is Inflation? In this chapter, we learned about what is inflation, and we learned how and why the government inflates the currency, and we learned how does inflation affects bonds and stocks. So I hope this chapter was helpful, and I hope to see you guys in the next chapter.